company, EastGroup Properties. So we're in the industrial sector of the REITs, and we are shallow bay. We would describe ourselves as shallow bay, which is another word, a euphemism for last mile. Last mile developer, acquirer, operator of industrial real estate, and our footprint is the Smile States, which is going west to east: California, Nevada, Arizona. Texas is our biggest market, Florida, Georgia, the Carolinas. And why those markets is that's where people are moving to in the country. So long-term population growth, and that's really where we fit in, is the warehouses that are delivering to consumers and to businesses infill in those fast-growing cities. Sure, we're one of the more interesting REIT histories in that our founder, a guy Leland Speed, and I started here as an intern in the early 90s. Failed REITs, he saw failed mortgage REITs, and we were a troubled land purchase leaseback REIT. So he would see net asset value of, say, $12 a share and a stock price of $8. And these were tiny public companies. So we were one of 7 non-self-administered public REITs when I first joined EastGroup. And then in the mid-90s, when REITs started to move mainstream, he had gotten management and ownership, and there was cross-ownership. We merged those down to 2 REITs, one office, Parkway, and then EastGroup, the industrial REIT. And we've been around. It was around in the 70s. Leland got control and moved it to where we are today in the early 80s. So we've been around. We're a long-term public REIT. I'm odd in that I've worked with real estate since the early 90s, but only in the public structure. And what I guess what I like about it, if I'll go from an investor perspective, you've got liquidity, you've got all the things REITs are supposed to deliver. Diversity. Every quarter, we've got our big 4 auditors in here going through our books. So all the things you see that you would want out of a public REIT, it's a way to get on parts of industrial buildings across the U.S., literally coast to coast, with auditing, with transparency, with liquidity, with a current dividend versus private real estate. So I like the REIT model, and we've raised or maintained our dividend over 30 years, raised it the last 14 years. From a sector level, and then I'll add into EastGroup, what we see is just in our markets, we've got several secular tailwinds. We're purposely where people are moving to. Those last mile locations, talking, the city, Orlando, Atlanta, Austin, Nashville, Phoenix, just continue to add people. And we only build one story traditionally. Everyone else is multiple. So it's harder and harder to get industrial land sites, and we use a lot of land. E-commerce is just this steady drip, gaining more and more of retail sales. Of late, and it's still playing out, is the onshoring, nearshoring, the China plus one manufacturing. So we see the investment, the battery plants, the green energy. We're not usually that plant, but we have suppliers to the Intel chip plant in Phoenix, suppliers to the Texas Instrument plant in Dallas, all the things like that. We end up participating and being near. So there's a lot of just secular tailwinds that move our way, whether it's onshoring, nearshoring, population growth. And that's where you've seen industrial really since COVID. We had this great run, it's leveled out a bit. I won't say a pause because our earnings continue to go up each year, but we have that tailwind, and then we try to do things to de-lever our risk, such as have a strong balance sheet, be tenant diversified, be geographically diversified, all the things like that are, I like our sector a lot, and then I always say I like where we fit on the playground. I think where we try to, as I mentioned, maybe position ourselves bear-wise, and then this year, I think if you ask a lot of institutional investors, I don't know if it's bear, but industrial's been out of favor the last couple of years, which has felt foreign. We've been in such a hot sector, it's thrown me to be a little bit, last year we were the worst of the sectors, or next to worst. Maybe timber was worse, which is foreign territory, thankfully, long-term. But this year, if we're kind of a flattish, we're going to grow our earnings over 7%. We just raised our dividend over 10% in third quarter. And so that if that's so our dividend and we've raised our average rent on a net effective in the 40%. So when we have such embedded growth in our rents and for all the tailwinds I mentioned, we still have inflationary type rent growth in all of our markets absent California this year. So we have embedded growth. We only get to about 15% of our leases per year. So our bear theory is if things don't improve, we probably grow our earnings 7 to 8% next year. We probably raise the dividend. Again, I don't know it'll be 10%, but we've raised it 14 years in a row. And then against the bear theory, what we try to do is we're a developer, but we'll build infill sites, but build a campus for park setting. So some of our peers, you go build, since you're in Dallas, 800,000 feet on the edge of Dallas, and you hope 4 or 5 people aren't doing it at the same time. We'll build 2 buildings, and as our customers expand, we pick submarkets we like and really feed supply into that demand. Our debt to EBITDA is 2.9 times, so we have the strongest balance sheet we've had in our company's history. We're geographically diversified. Our top 10 tenants are under 7% of our revenue. So we try to learn, every once in a while you're going to pick up the Wall Street Journal or read a headline in the morning that someone had an accounting scandal, went bankrupt, all the things. We try to do all the credit underwriting we can, but every once in a while somebody's going to, 1,400 tenants, someone's going to blow up. So we try to be as geographically diversified, tenant diversified, have a safe balance sheet, all the things like that we say we want to get you sector-leaning returns, but we want to do it with lower risk. So anything we can do to whittle away at that risk without harming returns, we'll kid, and myself included, it's a lot of recovering CPAs within our management team, and that probably shows in our strategy of being a bit risk averse. Look, I think we're the only our peers have last mile, but we're the only one that really fits into that group and fits into our markets and our balance sheet. We've been a public REIT, and look, we've been around long enough to have seen REITs come and go, and there is a learning curve. I think with a REIT IPO, I get why they're priced a little bit at a lower multiple, because there is a learning the public market sector. It's certainly different than the private market sector. I think today our balance sheet's stronger than it's ever been. We've spent a lot of time, we've built about half our portfolio, and what we've bought the last several years has been new products. So we're really being more and more Class A within our portfolio. Our multiple is, to use next year's consensus, we haven't released 26, but we're a little over 18 times. We're several turns below our historic average, whether you look at 5 years, 10 years, FFO multiple. So to me, you're getting it you're coming in at a very safe place, and you're going to get a growing dividend, a safe balance sheet, and we spend a lot of time on our capital allocation, exiting slower growth markets. We've entered some faster growing markets. So I think it is honestly a safer time to come into EastGroup. We've grown our earnings, but our multiple is about half of what it was. Maybe it should have never been high 30s, but where we were at the end of 21 to today, our earnings are up and our stock price is kind of sat there. So I don't suspect we'll get back to that kind of multiple, but just getting back to a historic average multiple, and our balance sheet is much better in our portfolio than it was at the end of 21.